Welcome back, everybody. And this starts our 10 piece, I believe it's going to be 10, series on challenges to market efficiency. So, this is going to look at what we've talked about in the previous videos and challenge mostly semi strong, where you need private information to have excess returns. And there's a little bit of weak form as well that we'd be challenging here. So we're going to go ahead and just jump right into the first challenge that was found here. Now behind me, I have the old capital asset pricing model, which originally believed that all risk could be captured in this systematic risk beta measure, where our market beta was 1, and then we could fit our stock or whatever security we had on that beta line, and it should be able to price perfectly. And here's our first challenge. We found that small cap stocks, challenge number 1, small caps outperform large caps. So what does that mean? Small cap stock is the number of shares outstanding of a particular company times the market rate of which that stock is traded at. So if you have 1,000,000 shares outstanding and you have a $20 stock price, that is a $20 million market cap. Now, in this world, the numbers are larger than that example, but we define typically market caps of small as 2 billion or less. So less than $2 billion. The large cap, I've seen it in a couple different ways. It's either going to be greater than 1 or $200 billion. Those would be defined as large cap stocks. So basically, you're just going to group all those together, whatever you can find for less than 2 billion, and then whatever you can find for greater than 1 or 200 billion, depending on your criteria. Just looking at NVIDIA here in the summer of 2024, and they have a market cap of 2.5 trillion, just to give you some basis of what some of those mega large caps look like. And so what we found here, though, is that small caps outperform large caps. And that, hopefully, if you're thinking through this, should not come as a surprise on the surface. I think of small caps as just getting off the ground, and they'll have a more uncertain future and less established. And so that all of that taken together means there's more risk, which means it's riskier. I'm going to need more returns on that. And so small caps outperform large caps. Here's the kicker, though. After we factor in risk, we run risk, and then we still find, after factoring risk, that's the important part that makes this interesting. After we factor in beta, those small caps still outperform. So I want to just show you a very basic example on what that might look like using the capital asset pricing model. So this will piggyback off of what we talked about in that previous couple of videos. And let's say we have a small cap, we aggregate all these together, and our small cap return has 15%. So here's our small cap fund with a return of 15%. And we're going to use a risk-free rate of 2%. And we realize that it has a beta of 1.5%. So once we're essentially saying is it's 50% higher, 1.5 times the actual market rate or the market volatility. And then we'll use 10%, 0.10 as our return on the market, and our risk-free rate is used here. So now we see here, okay, we need to add in a different factor because we have all the numbers and it doesn't add up. So what we have here is our golden goose. What we call alpha in finance is our excess risks. This is our excessive returns here. I'm sorry, this is not excess risk, it's excess returns. That's the golden goose. And so if that's positive, then that means it is excess. And so here, 0.08 times 1.5 equals 0.12 plus 0.02 gives me 0.14 plus alpha equals 0.15 over here on the left side. And so we just scrub that out and we can see that alpha is 1% for this small cap fund. So we have excess return of 1%. With the large cap fund, we could do that just to show another example, and that returns 0.10. And we use the same assumptions, 0.02 plus 1. And that is going to be the same volatility as the market. And here's our risk premium that we used in the previous example, and then there's our alpha. And we can see there that 0.10 equals all of that 0.08 plus 0.02. And that means alpha is 0. But again, we find that we can find some positive alpha when we even factor in beta risk. And that's what is either inefficient. That's why we're challenging the efficiency. And that's why Fama-French added this small cap factor into their new 3-factor model. But we did all this work and we're showing you that this is generally how this works. Small caps definitely are favorable. If you took the intro to behavioral finance, you could actually reason that some of the reasons behind this is because people don't like volatility or excessive risk. So they're very risk averse and loss averse. So that would tend people to shy away from some of the more volatile stocks. But it also creates an opportunity for those who are willing to take more of a roller coaster ride, because in the end, it will have excessive or abnormally positive returns. So if I'm going to play this and believe that this is still the case, then small caps are going to be how I would try to create my portfolio in order for the long term. All right. So we'll leave it at that. If you have any questions, that's 1 of 10. Any questions, shoot me a note. Let me know. Would love to hear from you. Otherwise, let's see you on the next video.